Okay, so when you're out in the small business community, networking, bonding, building relationships, what is one common credit myth that kind of comes up?
Yeah, I would say one of the most common credit myths that I hear about, and there's a lot, but one of the more common ones is paying off a loan to improve your credit score. So we'll see people getting ready for a business loan or even a home loan who think that once I pay off my auto loan, I'm going to see this big boost in my credit score. Unfortunately, it's not the case. I think the misconception comes from credit utilization being a factor that impacts your score. But the credit utilization ratio, which is looking at what is your balance versus your credit limit, that's just really focused on credit cards. So the great thing about a loan is it doesn't matter if you start the loan with that full balance that you took the loan at, as long as you're paying it on time, it's going to help your score. When you do pay it off, it closes, and that closure can cause a drop in credit scores because what happens at that point is only the open and active accounts impact your credit. So it's a closed account. So if that gave you 5 years or 7 years or 10 years of history, you just adjusted the average age of open accounts on your credit report, and maybe you shortened it. If you have a ton of credit history, maybe it's a very minimal blip. It doesn't impact you much. But if you have less credit history, you may see a bigger negative impact from that. So I would say that's one of the more common myths out of many we could discuss.